Hi, everyone. Good morning. Welcome to the webinar. Let me start by giving you a quick overview of what I've planned for today. And then I'll also share a little bit about who I am, actually, that is leading the webinar today. Basically, this is part of a webinar series of the Competence Center for Social Innovation, which is a EU-sponsored project, and we at FASE are a part of those partners running this webinar series. And I am Christoph. I'm a transaction manager at FASE, Financing Agency for Social Entrepreneurship, and I work with social enterprises and impact startups in raising funding from impact investors. So this is essentially my main role, and I've been doing this now for quite a few years. In today's webinar, I want to share a few topics with you. First, obviously, give you a little bit of background of still who we are, but then speak in particular about who are actually impact investors, because it's kind of always the big kind of phrase and theme out there is the impact investors. We all know what they want, but do we really? So I want to share a little bit about who are actually impact investors and how can we look at them from maybe different angles. And then a main part for today would indeed be to actually try to think from the perspective of an impact investor. How does impact investment readiness actually look like? And what does that mean? Why would an impact investor decide to invest in your company, for example? And then if you still have time, because that depends a little bit on how much I talk and how many questions you ask, we can also look a little bit at how a typical investment process would look like. And just a little bit of housekeeping before we start. You all had to accept this recording button. That essentially means this is being recorded and will be put online for later viewing as well, if you want to go back to that, or if other people would want to look at that. So if you by any means feel uncomfortable, for example, being on camera and being recorded, just feel free to turn the camera off or type in the chat and the like, and that's totally fine. That just as a bit of housekeeping beforehand. Let us look a little bit of what where we stand with regard to those webinar series. This is the third webinar of a total of actually 5. 4 I've listed here. We had 2 other webinars on impact investing, on measuring and managing social impact. And we have another one in 2 weeks' time with regard to scaling impact and systems change. And then we have already 2 others planned, but that is still top secret, but it's going to be very exciting in April, where we most likely will have actually some discussions with social entrepreneurs that have already successfully raised funding, so we can kind of plug their brains a little bit and understand what they did and what went well. Right. So FASE, just really quick, because I don't want to spend too much on that. I mentioned that already. We're essentially a bridge builder between social entrepreneurs and impact investors. We connect the dots between them to, on the one hand, help social entrepreneurs to understand better the investment landscape and what is needed to attract investment and coach them. And also then, on the other hand, have the impact investors themselves who we connect them to. And we're essentially in the middle working on, from financial model to pitch deck to the whole equity story and the structure of a transaction when it comes to raising funding from impact investors. The challenge when we look at investment readiness and investing in social enterprises is that the majority of investors typically always wait at the end of the pipeline. They don't want to do the groundwork. Obviously, they want to invest in companies that, in their understanding, are investment ready. And another challenge that comes on top of that is that even if they consider themselves impact investors, 85% of those investors that actually tell about themselves that they are impact investors actually expect kind of market rate returns. Now, market rate returns is always a little bit of a fluffy word, but essentially it means that they do want to see high growth companies. So questions is obviously for you as a social enterprise, do you want to attract the ones that, maybe essentially want to attract market rate returns, or do you also maybe want to focus on those that, for example, have lower return expectations? But I'll share a little bit later on how we would classify different investor types. For early stage companies, essentially, that brings us to a challenge where, on the one hand, we might be for profit, we might be non-profit, we might be somewhere in between. So maybe it's not always possible to have these kind of like high, returns that maybe a professional investor expects. So the question is always like, on the one hand, how do we go about that? And what does that mean for investment readiness? How do we need to, present our company to become attractive for investors? Essentially, the setup and the motivation of investors can vary. And it varies because they come from different backgrounds, essentially. I put a few investor types out there that we typically see when we work with social enterprises that and impact startups that want to raise funding. So maybe some of them, like you heard the name, so business angels, very traditional venture capitalists, is kind of like what you see like in the Berlin and the London startup scene, for example. We have crowdfunding platforms, we have social business angels, we have family offices, and sometimes a little bit in between, social venture funds, banks, and foundations. Now, why did I put them in this order, essentially? And there's a few different aspects on that. If we look at the investors on the left, so for example, business angels, or also people who invest via a crowdfunding platform, those are the ones that typically invest their own money. And when we look at like the right, so if we look, for example, at a venture capitalist, or if we look at a bank, for example, this is typically the ones that invest other people's money. So that comes with different strings attached. So the ones that invest their own money can, they invest maybe in things that they just like, maybe they like the team, they like the product, they like the idea. And sometimes they have maybe an investment hypothesis behind that on how much return they would want to make, but sometimes also not. So it's more kind of like they're very often more flexible a little bit in their approach. And especially when we look at, in particular, social business angels, obviously they do have already some experience working with social entrepreneurs. Now, when we look at the investors on the right, like the venture capitalists, the banks, etc., because they invest rather other people's money, essentially, what that means is that they have a clear investment hypothesis on what they look for, what they need to see, and what they essentially only can invest in. And very often those have also limited exposure to social entrepreneurs in the first place. Now, so especially for early stage social enterprises, we would rather see the investors on the left side. So like the social business angels, the crowdfunding platforms, foundations, business angels. But one thing that I want to actually put before we even like dive into all of this, which is investment is only really one option. If you, for example, are a social enterprise that is able to, we call it work in bootstrapping mode, as in like you finance yourself through your own revenues, maybe through your own savings, that is always a great option, because you always have to think that if you take an investor on board, and whether that's a loan or whether that's like an equity investor, all of that means essentially that there will be different strings attached. That is something that is a decision that is all, up to you to, in the end, to decide which way do you want to go. And both is fine. There's no right or wrong with it. It's just that it's different. And for you as a social enterprise, it has different strings attached. So when we look at impact investors in the first place, we essentially kind of classify them into, even impact investors, into different categories. Now, I put next to impact investors still kind of like the donors. The donors are not really investors. They just donate money, essentially. So if you are a nonprofit entity, for example, you have a good chance of acquiring donor money. And that would mean you go fundraising for donor money that you don't have to pay back. And that is fine. And that's a totally valid way. But today we really want to speak about the investor side of things. So not so much about the donor side of things, because that has different, requirements to it. On the right-hand side, I put the finance-only investors. So essentially, those are the ones that really just do not care about social impact. They just care about their financial return. And if you, for example, I mean, right now we see a lot of like climate tech startups being funded. For climate tech, it's essentially, okay, they solve an environmental problem, and maybe a social problem that is attached with it. But it can potentially make great money. So either way, whether you're an impact investor or you're a traditional investor, you might be interested in that. So sometimes you see that, you know, they invest alongside like a finance investor and an impact investor. But today really focus on those impact investors. And though I kind of like put out three categories for them: impact only, impact first, and finance first. And essentially, what it means is all of the impact investors, and I think that is a very important message here, all of the impact investors, if they invest into your social enterprise, first of all, do want to see their money back. And that is really how they differ from donors. Investors might, you know, want to have their money back plus a few percent or plus a few more percent, but essentially they want their money back. So that is what we classify as an impact investor. When we look at the impact-only investors, those are, you know, can potentially be foundations or so, for example. They might invest, they want the money back, but they don't necessarily want to have an additional financial return on that. They care really more deeply just about the social impact that you're creating, and they know that you need money to fulfill that aspect, and that later on you're able to pay back the money that they gave to you. The impact-first investors, those are the ones that, next to the finance first, are like the ones that we at FASE most typically work with. Those are the ones that expect also their money back, and then they want to have a few percent on top of that. Just a quick, since a question came in, will there be a replay? Richard asked that in the chat. This is being recorded, Richard, and it can be found on the Competence Center for Social Innovation website probably in a week or so. So you can rewatch it there as well. But going back to the impact investors, so like the impact first ones, they expect, we call it moderate returns. Now the question is always like, what is a moderate return? It depends on how the interest rate environment looks like. So it's a little bit technical, right? So right now we see that we are in a phase of like rising interest rates. So typically what we see, for example, from crowdfunding platforms right now, if you are a impact-oriented social enterprise and you raise funding via a crowdfunding platform, you might be anywhere between maybe 5 to 8% in interest rates per year over a duration of maybe 5 to 6 years. So essentially what that would mean is maybe around 1.5 times you have to pay back. So if you raise 100,000 euros over 5 years, maybe you need to pay back 150,000 euros. That is something that we would consider moderate right now. When we look at venture capital investors, for example, they would not be happy with only a 1.5 return, but they rather would have maybe a 5 times or a 10 times return even, or the potential to at least get to that. Now, for social enterprises, that's very often out of the question anyway. So impact first investors, moderate returns, finance first investors. We would classify finance first, for example, there's a lot of like venture capital funds that have an impact focus. So for example, like in Munich, we have like Ananda Impact Ventures, for example, a very prominent investment fund that invests in technologically oriented social enterprises and impact ventures. So they do expect their money back, but returns probably rather similar to like what we see on a typical startup financing venture capital model. So summing up here, impact investors come in different forms essentially, and it's quite important to find the ones that fit your needs, right? Depending on what type of business model you have, like whether you're very high growth, maybe a rather slow growth, what kind of like return expectations can actually be working for your business model. So that's something to just keep in mind when you look for investment, and always make sure that you kind of like understand the difference that if you're an NGO, you rather go for donors. If you're a for-profit minded entity, you can go for impact investors. If you're somewhere in between, like a hybrid structure, for example, either way can be an option going forward. Now, so let's walk the talk. What does it essentially mean for our topic of investment readiness? Investment readiness, the way we look at it, is essentially kind of like a set of questions that an investor might be asking you, or a set of questions and a set of topics on how an investor might judge your social enterprise. And very often these kind of like questions are grouped together in a few different categories. And what I want to do now is to just give you a little bit of insights on what types of questions might be asked from investors. So what investors might be, looking for when, for example, you send them a pitch deck and you're like, hey, I'm social enterprise. I want to raise 300,000 euros, invest in me. And how would they, for example, look at you, right? So 7 categories that I listed out here, depending on whom you ask, some will say it's 5, some will say it's 10, but in the end, it is always kind of like, similar. First category is team. Second one is product and technology, or maybe also service and innovation level of a service. The third one is market and competition. The fourth one would be traction. And traction essentially actually means, are you able to create revenues and how much and how? The fourth one would be finances and financials in general, and how that looks like. Then there's a part that's legal and admin. And then obviously there's one part that is called impact. Now, so what I want to do is to just give you a little bit of like background for each of these categories. So when we look at team, when we look at team, one thing that investors very often prefer, let's put it this way, it's not a make or break decision, but one thing that investors very often prefer is if there's some sort of like complementary team structure in the founding team. So let's say you have, for example, a technological solution that solves a social problem, and you are the business person in the founding team. Then the investor might ask you about who's the technical part, and if you, for example, have like a founding team that, let's say you have like a technical co-founder and you have like a business-minded co-founder, that in their eyes would, for example, help the case of investing. So it's not impossible, for example, to raise funding as a solo founder, but if you have a strong team with complementary skills, that is something that that investors value. Let's put it this way. However, and I think that's a very important part to say, just to give you kind of like 2 examples from my recent work. So in the past 2 years, I worked with 2 companies, for example. Both of them were solo founders, one male solo founder, one female solo founder, different age groups, and both of them were able to raise funding successfully when we worked together. And the question is always that investors, when they look at a company, they don't see like one category always as a make or break thing, but very often it's really the combination of all those categories and the combination of all those questions, and then also kind of like putting you in a bracket at which stage you are on whether they would see you as investment ready or not, right? So just to keep in mind, it's not impossible to raise as a solo founder, but maybe, for example, you need to show that you already have not just an idea, but maybe you already have like the product and it works, and people are buying it, for example, or the services that then kind of like helps the case to show that it's kind of like investable. So team, one category. Main message: the more complementary skills you have in your team, the better. But it's not impossible to raise as a solo founder. Good question now in the chat just now. What about a solo founder outsourcing everything from expertise to services? Now, it's a very good question, because essentially that's something that you could do. You have a solo founder and then you like hire someone, or like you outsource it to, for example, third parties to do that. And it works to some extent. So let's say, for example, and when we, just to give you that concrete example, so when we worked with that one startup that had a single founder last year, where we or 2 years ago, when we raised successfully, they even had their technological team outsourced, and it was possible. But why was it possible? Because they had a very, very clear USP and access to a market where others did not have. So the technological component was like important, and it was very important that they have that, but it was not like rocket science, for example. So the USP was rather the way they are able to enter the market and the way they are able to build a sales organization in a market that has been super difficult for many, many decades to enter. And that kind of like proves that point again. In the end, it's the combination of factors on how investors would look at a company. You can obviously have like different, people to do things for you and hire them. They don't have to be in the founding team necessarily. You can also outsource parts, but you always need to kind of like look at all the different categories in and how they come together in order to convince an investor in the end. Right. So product and technology. And it kind of like, closely correlates to that. What investors would always look for is, do you have some sort of a USP? Is what you're doing really special? And that USP can be, for example, the technology. It can be, the market access, as in this particular case that I just described, for example. It can be that you have like a product that others have like not even like looked at, for example, or not developed yet. So like there's a lot of different ways on how you can show a USP. It can also be like barriers to market entry, for example, so that you are a first mover and others might need 2 years to enter the market. So something that really makes your solution special. That is something that very often investors look for, because from an investor's point of view, essentially they kind of think in investment themes. So for example, you're solving a certain problem, but there will be different solutions to it. And it might be a bet on which solutions wins, or like, it's like the one that, can become profitable. And so an investor would always be like, okay, but why is it that you believe that your solution, your service is the one that can essentially create revenues on that? And then important also for product and technology is kind of like value proposition. And what it goes back to is, do you solve a real issue? Now, we're obviously among social entrepreneurs here, and I'm very certain that most of you really solve pressing issues. So if we look rather, for example, at, I don't know, the next delivery service, or like the next, I don't know what, I mean, yes, it might serve a problem that I'm too lazy to go to the shop and therefore get it delivered to me, but is it really a problem? Challenging, right? It's quite important to focus on what is like, is it really a problem that you're solving? And do you have, and that's quite important here, do you have someone that is willing to pay for it? Because you might create a great solution that works for people or for like the target group, but it's not possible that they pay for it. And that, from the eye of an investor, is challenging, because in the end, they want you to create revenues through your product, through your service. Because if you're not able, then you're not able to pay back the investment. So it's very important to have this match between you have a great solution that you have developed and someone is willing to pay for it. Market and competition. Here, two things to that. One is investors very often look at market size. And why they look at market size is that they want to see, is it really just a niche market where maybe your target group is 500,000 people and they all are able to pay 10 euros, then your maximum revenue ever would be 500 times 10, 5 million, let's say, euros. But you maybe only reach 10% of that. So maybe it's only like 500,000 euros that would be your maximum revenue that you're able to create. Now, if you want to raise, let's say, 1 million euros for that solution, but your maximum would always be only 500,000 revenues, it might be difficult to pay back that 1 million euros, because you have also other costs involved typically. So that's why investors look at the market size, like, is the market big enough that you're able to grow the company? And because if you grow, then at a certain point you will be profitable, and then you will be able to pay back the investment. So that's why investors look at market size, essentially. What they also look for, is it a growing market or is it a shrinking market? Typically, investors prefer to invest in growing markets. So if we look at social enterprises right now, for example, anything that is related to, for example, elderly care is like very interesting, because just by the sheer demographics, it's a growing market, right? Or things that are related also to let's say healthcare in general, for example. It's also a market that is like very interesting. So social entrepreneurs, obviously, like we want to solve problems that we deem pressing from a social perspective, and maybe that is a market that, if you call it a market, it might even be shrinking. But we always have to keep in mind that it might be less attractive from an impact investing perspective if it's a shrinking market rather than when it's a growing market. And the last part to market and competition is essentially competition, right? I mentioned that briefly before. Investors, when they look at companies to invest, they typically don't look at it only as your company as a standalone decision, but they compare you with other possibilities on where they can invest. So maybe an investor has, I don't know, maybe 10 different opportunities where they can invest, and they only have 100,000 euros to invest. And each of those 10 companies would want to have 100,000 euros. So they will pick one, right? And they pick one based on a lot of those different, aspects that we're talking about today. And one of them would be competition. So if they believe that, let's say, there are other companies out there in your specific target market for your problem that you're solving, that maybe are bigger, that are better, that have a better technology, that solve the problem like in a more innovative way, it might be difficult to get funding. But if you're the one that can portray it in a way that you're actually the one that can beat the competition, because you have a strong USP, you have a strong team, you have, like, let's say, a strong product market fit of what we call it, they might be more willing to invest in you. So it goes hand in hand. How good is your solution, your product? Is there a USP, like a unique selling proposition to it? Do you have a strong team executing that? And if all of that comes together, the likelihood of receiving an investment from an impact investor will be increased. Right. And just as a quick housekeeping again, if there's any questions, feel free to type them in the chat. And I have the chat in front of me, so I can pick up on that directly. So market competition, attraction. Traction essentially is one way for investors to say we want to see revenue. I mean, there's different ways of how you can show traction. For example, pilot agreements, or I don't know, like users in your app, for example, or a lot of things. But essentially, it goes down to, can you show that someone is willing to pay for your product? Now, that obviously for early stage social enterprises is difficult. So it goes back to kind of like looking at investment readiness holistically. If you have a great idea, you have a great team that is working on that idea, if you have shown that there is some sort of willingness to pay, because maybe you have like some letters of intent, or like you have, for example, a market study that shows there's something out there, then it's also possible to say like, okay, I don't have revenue yet, but I need, pre-financing for the product development. But generally what we do see is that it gets easier the more you can show that there's some willingness to pay in the market. That's why we also very often see that in the beginning phases of like a social enterprise, or if an impact startup, that very often they might be funded, for example, by public programs, like whether it's like incubator programs or accelerator programs, or some sort of like, grant funding programs that bring them to that stage of like, the initial product, the prototype is there, maybe even like the first customers are there. And then it gets, quite a lot easier to raise funding from impact investors. There's one question out there. Do you have an example where investors have invested in social innovation which leads to some kind of systemic change, not just a social enterprise solving a problem? A very good question. And I think it goes back to the question of like, what is it that you're selling in some way, right? Because in the end, if like the solution or the product or the service that you come up with, find someone that is willing to pay for it, while solving somewhat of a systemic change, then it would be investable. But if it's something that is creating systemic change without a service or a product or a deliverable that people pay for, then it's challenging, right? So I think from an investment perspective, it's always important to have someone that is able to pay for your product or your service or your deliverable. And once that is there, it's not so much about whether it's, for example, only solving a problem or whether it's really creating systemic change. But when, and maybe I jump into that impact part a little bit now before I dive deeper there. When we look at like impact investors and how they look at impact and why they invest in impact companies, very often one thing that we hear is that impact needs to be embedded in the business model. So there are obviously companies out there that, for example, do this 1+1, I don't know, model. So like you, I don't know, buy a bag of beans, coffee beans, and automatically another bag of beans is being donated to, I don't know, like a social institution or something like that. The question is there really social impact embedded in that business model? And we personally think it's a little bit tricky. Some would look at it otherwise, but we would personally think it's a little bit tricky because essentially the business model is selling coffee. And you just put like, you know, a donation part on top of that, that might be part of your brand identity, but not specifically part of your business model. Now it might be different. For example, let's say if you, let's stay with a, you know, example of coffee beans, for example, if a part of your business model is essentially, for example, to, let's say, roast, like if we look at the coffee value chain, a little bit of background, if you look at the coffee value chain, most of the money is actually in that value chain being created in countries where the coffee is roasted, where it's sold. So typically, for example, let's say Western Europe, where we are right, where at least I am right now. And the producing countries, for example, Ethiopia or Rwanda or so, get very little. So like only the raw materials, the green beans, essentially. Now, there are social enterprises, however, for example, that try to disrupt that value chain and support the creation of actually roasting facilities in, for example, Rwanda or Ethiopia or Kenya, and then that roasted coffee is being exported. Now, so what that essentially does is that social enterprise does, on the one hand, solve a problem. That means that there's more proceeds being kept in the origin country. So like we have like a triple down effect in essentially, and more money there, and less money, let's say in Berlin, where I am, for example. And at the same time, I'm not sure whether it's already like kind of systemic change, but it at least disrupts some sort of value change that is being, you know, historically unfair. So in the business model itself, we have a clear model that works towards, you know, impact in its core. I'm not sure if that fully answers your question, but just kind of like as some examples to that. But so going back to the idea of traction, essentially key message here, are you able to have paying customers? I think that is really, really important. And very often up to that point, you might be financed via grants or the likes, and then afterwards it might get easier to raise investment if you can already show that you have like first revenues. Right. Finances. Finances, that is more of a checklist topic, to be fair. It's more like what essentially I want to say here is important that you have an understanding of your cash flow management, for example, that the investor gets a confidence that you have your numbers in order in a way. So let's say that you're able to say, okay, I don't know, every month I spend, I don't know, 5,000 euros, so I need 10,000 euros for the next month, or like 20,000 euros as an investment. I would want to hire that person, XYZ. Just kind of like have a clear projection of like how much money do you actually need when it comes to investment, you typically want to raise for at least 18 months, maybe even 24 months. So what is it that you would want to do with that money? That is essentially what the key message here is. Because very often this kind of like financial plan that you create would then transform to some sort of like a budget plan that you would then work with. So important to have some sort of like a financial model in place that can at least show, give the investor confidence that you have your numbers in order, that you have an idea about projections, about assumptions of like how much you can sell or not. But we all know when we look at financial models, in the end, reality will be different, but it's more about like the assumptions that you put in there and that they seem realistic and seem to make sense. So that's kind of like the important part on finances. Legal admin, it's also more of a checkbox thing. What investors would be looking for, or what they would consider investment ready, is it needs to be an entity that is kind of investable in a way. So like when we, I'm based in Germany, so we have company entities typically called GmbHs, like a British like Limited, for example. So investors would not invest, for example, just in you as a person, but it needs to be, a standalone company entity that they would be investing in, I think really kind of really more of a checkbox thing. What they would be looking for is like, do you have like your company incorporation documents in order? Are there any legal proceeding that you have maybe prior that are not solved yet? That would be kind of like roadblocker sometimes. But it's really more of a checkbox thing, and it's something that only later on in what we call a due diligence process would even like surface. Right. Now, impact. Last part of like the whole idea of like different categories of investment readiness, and obviously a very important one for impact investors. What impact investors would be looking for when it comes to impact is, on the one hand, what is actually your impact theory? So do you have some sort of like theory of change in place, like an IOI model, like input, output, outcome, impact model, some sort of like that type of model where you can show what are you doing, what kind of like output and impact are you actually expecting from that social enterprise that you're running. So that's quite important to have like a theory of change, or like a result staircase, some sort of like those kind of aspects. I often get asked the question, to what extent is it needed that you are able to measure your impact, and how investors would look at that. And essentially there's two answers to that. And the first one is, it depends on your stage. Now, why does it depend on your stage? Is because when you are just starting out as a social enterprise, it's more important to show intent and ambition to like the social cause that you're solving and how you want to solve it, and show what the theory of change will be or can be, rather than being able to explicitly measure it. That is because measuring is sometimes just comes after you've obviously tried to solve the problem, and then also it's something that is more complex. So for very early stage companies, that would not yet be expected typically, but the more mature you are, the more important impact measurement becomes, and also that you can measure those sort of KPIs. Now, obviously, for environmentally focused social enterprise or environmentally focused impact startups, it's easier in a way to measure impact, because I mean, in the end, you benchmark it, for example, against CO2 savings potential, etc. So it's more straightforward in the sense. And for social interventions, it's something that is always a bit more complex, just by the sheer nature of it, because social interventions are more complex to measure. And that's why it's something rather that is for later stage. And we did have specifically for the topic of impact measurement, we did have a previous webinar. So feel free to check that out on the KoSI website if you haven't been able to participate, where we go into much more detail into how impact measurement and management can look like. One thing, however, that's still important for the topic of impact is what investors would potentially want to see is, are you aware of any unintended impact that can come with your solution or with your product? As it could be there, like when you run, for example, your programs or when you run your services, could there be a negative impact, come with the positive impact that you actually are intending? And how is it possible to mitigate a potential adverse impact? Those are things that investors might be looking at and ask you about. So now I've been kind of like through all of those categories. Let me just kind of try to quickly, sum up on the key message here. Essentially, the key message is impact investors look at social enterprises from a lot of different categories, and it's not a typical only a checkbox thing. Do you have that in order or not? But it's really a combination of factors, and since every investor is a little bit different, they might value certain aspects more or less. However, if you are well prepared along all those different categories about the topics that we discussed, you might be one step further already with regard to investment readiness. And you might even, when you go, for example, to speak with investors, might be better prepared. I think that would be really kind of like the key message here. And then we have another question in the chat. Let me look at it real quick. So if social enterprises use mostly theory of change model, then what are the measurement frameworks used on the investment level, and who and how takes the responsibility for unintended consequences? That's a bit of a tricky question. The measurement frameworks used, that depends very often on the investor themselves. So what we see is that in particular, when we look at institutional investors, so social venture capital funds, for example, that they will come up with very often a very specific for that company, a very specific kind of like impact measurement. And what we also see is that it's very often for already like in the investment agreements, it's kind of like agreed upon what KPIs to measure. And so it's difficult to answer because it really depends on each individual company and also on each investor on how they look at it. There's not a one size fits all kind of like framework that would be applied there. And who and how takes the responsibility for unintended consequences? Now, I think it's more, I think I would kind of like ask the question in reverse, like if an investor identified that there are clear unintended consequences from that particular solution, it might mean that they would not even invest unless, for example, the company has a clear pathway of like showing how that could be mitigated. And then in the end, and I think that's if it is about kind of like investment readiness again, when we look at like the unintended consequences, I think it depends a lot on, is it a legal issue that arises from it, or is it a non-legal issue? And then it becomes a little bit complicated on who would be responsible in the long run. Right. So with that, I would just give you like, and because we have 15 minutes left, so I want to share maybe just 5 to 10 minutes about a little bit about like an investment process and what is needed, and as throughout the whole webinar, if there's any questions, feel free to like put them in the chat. But so essentially, when it comes to getting ready to approach investors, 4 things that you could kind of like should keep in mind. One is think of it that it takes time. What we typically see a typical investment process and might be maybe up to 6 months. So be aware that from reaching out, like from preparing your documents to reaching out to the first investors to like, talking with them, and you will hear a lot of no's. So not every investor that you talk to will say yes, obviously. And typically you need a very wide funnel of like potential investors to speak to. And then in the end, some will drop out in the end. So it takes time. So be prepared for that. Have all the right documents in order. Important also to get good strategic support, in particular, very valuable to have a good lawyer, because in the end it's about contractual details, right? And never underestimate that investors, they do that very often to invest in a company, but for you it might be the first time. So having like a lawyer at your side or experience from others that have been in similar situations might be very helpful. And 4, kind of like mindset is because an investment process does take time. So you gotta, stay flexible and adaptive in a way that maybe you want to raise $1 million and it doesn't work out. And maybe you figure out that there's a plan. You can also do it with 300,000 and it kind of works out. So think of like, adapt to the market feedback and that, important. Also, don't forget about your core business, because essentially what we see is that a fundraising process sometimes can feel like a second job next to your original job, because it can be very time consuming. The investors will ask a lot of questions. You will have to prepare maybe a lot of like additional documents that they would want to see. So be aware that you need to, block a little bit more time than you might anticipate. So typically when we look, and that really just real quick, and then I also want to open up the room again for more questions. How would a typical investment process actually look like? It's, you start very often by preparing of your financial plan and calculate how much money you actually need, because that's quite important. And then kind of like do a sanity check. Is it that, now, I don't know, I build a plan and it says I need 5 million, but I'm only myself and I don't have a team yet. Will it be realistic to raise 5 million? Or might it be more realistic to raise 200 or 300,000? So, always do a little bit of a sanity check and speak with others that have raised before of what can be a realistic goal also to raise. Then it's about preparing the pitch deck. Typically, we have like key content in the pitch deck, whether it's like the problem solution statement, the market size, the growth path, how you actually, want to make money, what is your team composition. There's a lot of good information in the internet about sample pitch decks and sample categories of pitch decks. So be aware that it's prepared well. And always think of it from the storyline of an investor, right? Don't think about only from your perspective, but really think what questions might an investor ask if they, look at your company. Then you identify the relevant investors. And in the end, you speak with the investors. There will be a lot of further questions. And then at one point in time, hopefully, you will get to the point where the negotiations are successful and you sign a contract and it's a disbursement of funds. And I like Johanna's comment in the chat here. This should be a roller coaster instead of a straight line. You're absolutely right. I mean, I obviously I do that for a living with FASE, that we work in these processes, and technically I should be somewhat detached from that because I'm obviously a service provider. I do that, on a continuous basis. But even for me, like working with like social enterprise and impact startups, it is sometimes really a roller coaster. You have like one good investor talk, and then you're like all excited, and then you have the next day one that is like not successful, and then you're kind of like your mood can indeed somehow vary throughout that process. But it's always important to obviously not take it personal. Any negative feedback from an investor is not a negative feedback about you, but it might be just that along all those categories that we discussed earlier, it might not be the right fit for them. So always keep that in mind as well. Right. If there's any questions, feel free to send me an email. And if you are in need of funding, obviously feel free to approach me. Happy to look at your deck and see if we can do something for you. But yeah, so with that, I think we have a few minutes left. I would close my input session here. I hope it was useful for all of you. Yeah, if you have any questions, feel free to ask. You can also just unmute yourself and talk. I think that's fine. Yeah, appreciate you being with us here today.
Yeah, thank you for your input. I think a lot of my questions were answered by it. Maybe one thing where I would like to get a bit more information is how the usual link works between the amount of capital and the return, because we also experience different ways, and maybe you can give something like from your experience, if you experienced any differences, maybe also in impact startups or from impact investors towards usual venture capital funds. And maybe as an additional question, we are a cooperative supermarket based in Berlin. And so as a cooperative, of course, it's also like we're kind of this hybrid form between we're kind of we're not a real official legal nonprofit, but we're not there to maximize our profits. Yeah, it's this hybrid system. And of course, we're also owned by all our members. So Super Co-op is owned by 1,120 people that have all like a vote in our General Assembly, which makes this whole logic also a bit tricky of like giving shares to investors. So yeah, I was just wondering if you have any experience with like member-owned structures.
Yeah, so you're registered as an AG, I assume.
Yes,
yes,
correctly.
okay,
yes.
Great. So first, maybe to the link between kind of like, I think it was about the investment sum and the return structure in a way. Right. So what we do see, and I think it goes back to kind of like there's different types of impact investors with different return expectations. When we look at like a venture capital investor, very often we see that a company should have, let's say, a potential to multiply their investment maybe by 10. That is only possible if you're able to sell a company. So if they invest in equity, in Eigenkapital, and let's say they invest 1 million euros, and they expect that out of that 1 million euros, it becomes 10 million euros that they get. It's only possible if there's a clear path to exit. Now, in a cooperative setting, obviously you don't have that because you don't want that to be sold because you're a members-owned cooperative. Now that essentially you can do equity funding, but the equity funding can only come from your own members, essentially. And then you can pay, let's say, a dividend onto the equity. So there are structures where that works. But what we very often see, and we've been working with cooperatives in the past, that it works with a so-called mezzanine structure. So in German called Nachrangdarlehen, a subordinated loan. And there, what we do see is what investors pay in particular attention to is, can you show from your business model and from your financial model that you're able to generate profits that are able to repay the subordinated loan over time, right? So that's very crucial to kind of like have a very good cash flow plan for that. And also like look at the balance sheet that, you know, whether you're obviously not over indebted, which is fine for subordinate loans, but you need to show that you at least have somewhat sufficient own equity from your members. And then afterwards you can put like subordinated loans into that. But key part here is really, I think, what investors would be looking at. You typically look at different durations. Right now, let's put it this way, it's easier to raise on shorter duration than on longer duration just because of the whole interest rate environment right now. But for a cooperative, we do see that it's possible to raise anything between 5 and 10 years typically, depending on the interest rate structure. Which should give you enough time to then create a business model that can pay back the invest over time. And yeah, I don't know if that answers your questions already, but I think the main idea was the structure would be via subordinated loan, and yes, it's possible, but it depends very clearly on the business model and how much of traction you already can show for your business model, because investors in that sense would be risk averse, that they want to see how how clearly are you able to actually pay back that subordinate loan over time?
Yeah, that makes a lot of sense. And interesting that you have experience with co-ops, because it's often not the case.
Yeah.
Maybe just to, like you mentioned earlier, 5 to 8% of interest rates are at the moment like a market rate. Do you have is it the same indication for subordinated loans, or do you have something in mind?
That would be indeed for subordinated loans. So like even a crowdfunding platform typically works with subordinated loans. So for example, also like we at FASE, we co-initiated an investment fund called European Social Innovation Impact Fund since 2 years. And the ESIF, as we call it, also purely does subordinated loans. And typically it's in that sort of interest rate range as well. Yeah.
Thank you.
Sure. Any further questions?
Hi. I have the pre-question because basically I'm an architect, a brick one, not a software one. So we have limitations in space and time. And what I want to do is integrate child and elderly care in an intergenerational way in the corporates. No? I'm a really, really early stage. I just did like 3 years research about it, but I'm not clear about the business model yet and about the impact. And the other part is, I know that it's a bunch of money from the EU, how you reach this kind of money, because how I measure impact if I don't put the KPI in advance. And measure impact in this case, in my project, is key. If you want to tell a corporate, invest $1 million, you will get 3 million because you will have less sick people and blah, 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 blah. And then I have a huge ecosystem, which I want to work in a corporate way. And I'm lacking the knowledge, basically, because I'm an architect.
Yeah, but first of all, I mean, it's super important. Great that you work on that. So first of all, congratulations on that. I get where you're coming from, and I think it's really the tricky part in terms of stage. Like, are you already at that point where it becomes relevant for impact investors, or are you at the stage where it's actually more needed to look for grant funding? And so the way you described it, and I think that would be where I would judge that you're more in, is to kind of like find, first of all, grant funding to be able to show that there is a business model that can work with it.
Yeah, I divide the project in 3 steps. The first is the grounding, then the pilot project, and then the develop. But I need the money for the grounding because I paid 3 years by my own pocket.
Yeah. No, I totally understand. Now, the challenge is that at FASE, obviously, we are not so much knowledgeable of grant funding. We are more knowledgeable about the part of the impact investors. I don't know where you are based.
Berlin.
Berlin. Okay. So what in Berlin, for example, what you could look at, there is a overview document called IBB Förderfibel. I don't know whether you have heard of that.
IBB Förder.
I can type it in the chat. This is a document published by the Investitionsbank Berlin, which essentially, I think, lists pretty much all, if not all, a large part of like known grant funding and also like loan programs for early stage companies. So maybe there's something in there for you. And other than that, it's indeed a bit tricky. I have to admit, it's a lot of research.
I have done. I was thinking to go to Stiftung who work with dementia because the pain. So basically, the pain point is women between 50 from 2006 until 2021, from 400,000 increased at 1 million who ask part-time to care. And the market, as you say, elderly care is amazing.
Yeah.
Okay, I'm going to check it. Thank you.
All right, perfect. Great. So I think actually now I am looking at the time, it's already 11 a.m. So I would unfortunately have to close, I think, but there would be probably a lot of more questions that we can discuss. And thanks a lot for all your questions. Found it super exciting to be here with you today, and hope it was useful for you. Again, the offer, if there's anything else you need, send me an email. I wish you all a good day and good luck and a lot of success with all of the ventures that you're building.